All right, let's dive right into this explainer. If you've spent any time at all reading business news, scanning through corporate earnings reports, or watching financial TV, you have almost certainly spotted this somewhat intimidating acronym, EBDI. It's one of those terms that constantly floats around trading floors and boardroom presentations, and honestly, it is absolutely central to financial literacy. But let's be real, it can also feel a bit like an exclusive club where everyone is just pretending they know the secret password. Well, today we're unlocking that door. We're going to break down exactly what this metric is, how the math actually works, and most importantly, how to use it without falling into a very common analytical trap. So, what does it actually mean? When a CEO is on an earnings call, proudly hyping up their margins, what exactly are they trying to draw your attention to? Understanding this is really your first step toward true financial clarity and making much smarter decisions when evaluating a business. Systematically breaking it down, EBITDA literally stands for earnings before interest, taxes, depreciation, and amortization. Yeah, I know, it is quite a mouthful. But honestly, this acronym is basically just a mathematical formula hiding in plain sight. Every single word in there serves a very specific purpose. We start with the core earnings, and then we're looking at that number before four specific financial realities kick in: the interest paid on debt, the taxes owed to the government, the depreciation of physical assets over time, and the amortization of intangible assets. Now, what's really cool about this anatomy is how it visually separates the pure profit from all the other elements. You have the earnings, that true profit, as your baseline. Then you add back the interest, which represents your debt costs. You add back the taxes, and finally, you toss in depreciation and amortization, which are your non-cash expenses. It shows us exactly what we're stripping away to arrive at this core metric. So the crucial point here is that by stripping away those specific financing and tax effects, what we're left with is the company's pure operating profitability. Think of it like looking at the day-to-day business engine itself, completely independent of how the company chose to finance itself or what tax bracket it happens to fall into. It clears away the mud and gives us a perfectly clear lens into the core operations. Okay, let's actually do the math here. To truly grasp this concept, I think it helps to move to a real-world example and just mathematically reconstruct this number from the ground up. Let's say we start with the base net income, the literal bottom line of $100 million. Well, we don't stop there. Remember that before part of the acronym? To get back to that before state, we basically have to work backward up the income statement. So we add back $20 million in interest, $25 million in taxes, a $15 million depreciation expense, and $10 million for amortization. And boom, those add-backs leave us with a final EBITDA of $170 million. That massive number represents the raw cash-generating power of the core operations, long before the accountants and the tax authorities step in to take their slices. As you can see, it's a very different, much larger picture than that initial $100 million net income. Now, seeing that significant jump from $100 million to $170 million, you're probably wondering, why do analysts and creditors even go through the trouble of calculating this specific number in the first place? Like, why not just look at net income and call it a day? What is the practical point of doing all this math? Well, it matters immensely because it essentially levels the playing field. First and foremost, it measures core operating performance. By filtering out all the noise of varying debt loads and different tax burdens, it makes it so much easier to compare completely different companies, totally apples to apples. And that right there is exactly why it's such a foundational go-to metric for investors and creditors when they're doing business valuation. But wait, hold on. Before you run off to start analyzing businesses with this shiny new tool in your belt, we need to slow down and address a very dangerous, albeit incredibly common, misconception. This is the trap that catches so many people who are just getting familiar with financial metrics. They see a high EBITDA number, they see that it removes non-cash expenses, and they jump to a completely flawed conclusion. I literally cannot stress this enough. EBITDA is absolutely not the same thing as cash flow. Period. End of story. Yes, it's a fantastic metric for assessing operating profitability, but if you substitute it for actual cash flow in your analysis, you are going to get a dangerously distorted view of a company's true liquidity and financial health. It's a massive mistake. So why is treating it like cash flow such a big mistake? Because EBITDA is really only one piece of the puzzle, not the whole story. It completely ignores some harsh financial realities like capital expenditures, which is the very real cash a company has to spend just to maintain or grow its physical assets. It also ignores changes in working capital, which can tie up huge amounts of cash in things like unsold inventory or unpaid invoices. If you're only looking at EBITDA, you're flying completely blind to those massive cash drains. The golden rule here: always look at the full financial picture. This is why educational resources and frameworks, like the one we're referencing today from FinQ Nexus, consistently emphasize one key lesson. Achieving true financial literacy means you have to look beyond any single metric. You've got to combine these individual numbers to understand how they interact and form the complete reality of a business, rather than letting one isolated figure do all the heavy lifting. Which brings us right to our final thought. Financial clarity leads to smarter decisions. Look, EBITDA is a fantastic tool to have in your analytical toolbox, for sure, but only provided you know exactly what it measures and, more importantly, what it misses. So the next time you see a company boasting about their record-breaking EBITDA, ask yourself, are you seeing their true financial health, or are you just looking at the part of the story they want you to see?